Welcome to the deep dive. Today we're looking at permanent life insurance,
Right.
but maybe with a bit of twist. Most people, think family protection. Crucial, obviously.
Absolutely essential.
But our source, Diversified Insurance Brokers, they're talking about using it for retirement planning too.
Yeah, that's the angle that often gets overlooked. It's got this dual purpose.
So our goal here is to kind of unpack that, cut through maybe some assumptions people have and see how it might fit into a long-term financial picture.
Exactly. It's not just the death benefit, which is, of course, primary for many. It's also this accumulation of cash value, tax-deferred cash value.
Okay.
And that can be really powerful. You're protecting your family, yes, but also building an asset that could, help bridge retirement gaps later on.
Right, right. So this cash value, how do people actually use it for retirement? You don't just cash in the policy, do you?
No, not typically. If you want the best outcome, you access that value mainly through policy loans or, in some cases, withdrawals.
Loans or withdrawals, okay.
Right. And here's the kicker, if it's structured the right way. Taking loans against the cash value isn't usually considered taxable income.
Ah, okay. So you're borrowing your own money, essentially.
Kind of, yeah. It's borrowing against the policy's value. The money inside grows without getting hit by taxes each year. And then accessing it via loans can avoid creating a tax bill right then.
And the source mentioned this doesn't bump up your taxable income for things like Social Security calculations either.
That's a potential key benefit, yes. It gives you a level of control and predictability in retirement income that might be different from pulling money out of, say, a 401k.
Which usually is taxable income.
Exactly. So this offers flexibility in managing your overall tax bite during retirement.
Interesting. So who's the ideal person for this strategy? The source points to people between, 30 and 60?
Yeah.
Especially if they're already saving in IRAs or 401ks.
Yeah, that age range often hits the sweet spot. You're likely thinking about family needs and the long-term future. And if you're already maxing out, or at least consistently contributing to traditional retirement accounts, this can act as a sort of supplementary diversified savings bucket. Different tax treatment, different access rules.
What about flexibility? The source talks about premium payments and control.
Well, many permanent policies do offer some flexibility within limits on how and when you pay premiums once the policy is established. And as the owner, you generally control the policy decisions.
Okay. Now, this point about distributions not being tied to the same income thresholds or contribution limits as, IRAs, that sounds like a big deal for planning.
It really can be. Accessing the cash value isn't governed by the same contribution limits or required minimum distribution rules you see with qualified plans.
So potentially more predictable income.
Potentially, yes. It offers a different kind of control.
Okay, but there's always a catch, right? The source brings up something called a MEC, Modified Endowment Contract.
Ah, yes. This is absolutely critical. You have to structure the policy correctly. A MEC, well, it's basically a life insurance policy that the IRS decides has been funded too quickly, with too much money up front relative to the death benefit.
Okay.
If your policy becomes a MEC, it loses a lot of those favorable tax advantages we just discussed, especially for loans and withdrawals. They start getting taxed more like annuity withdrawals. Gains come out first and are taxed, plus potential penalties if you're under 59 and a half.
Ouch. So avoiding MEC status is paramount for this retirement strategy.
Paramount. It means careful planning on funding levels right from the start and managing it over time. It's not just set it and forget it if you're focused on the cash value access.
So managing funding, understanding loan strategies, it requires attention.
Definitely. You need to work with someone who understands how to design it properly and monitor it to maintain those tax benefits.
And growth isn't always guaranteed, right? The source is clear on that.
Correct. Performance depends on the type of permanent policy. Whole life often has guarantees on the cash value growth tied to the company's performance. Other types, like universal or variable universal life, might offer potential for higher growth, but less certainty and more market risk.
But even then, the source mentions stability and downside protection in a well-designed policy.
Yes. Compared to direct market investments, many policies aim for smoother, more stable growth, and some offer floors or guarantees against loss, which can be appealing for long-term planning. Diversified Insurance Brokers really stresses designing solutions specifically aligned with those retirement goals, income needs, and family protection.
It sounds like it's about seeing it as part of a bigger puzzle.
Exactly. It's a versatile financial tool, more than just a death benefit payout. It's about purposeful planning for the future, both for your family and for yourself.
So wrapping this up, the big takeaway seems to be Don't just write off permanent life insurance as only death protection. It can be a serious player in a retirement strategy.
Precisely. With that tax-deferred growth and the potential for tax-advantaged access to the cash value, it offers something different.
Definitely food for thought.
Yeah.
It makes you think about how different financial tools can work together, not in isolation.
Hmm.
So maybe a final thought for everyone listening. How could blending different tools, your 401k, maybe an IRA, and perhaps something like strategically used permanent life insurance, give you more options, more control, and maybe more security down the road? Something to consider. Thanks for joining the